We detected an unusual trade worth $22 million on super microcomputer stock, ticker symbol SMCI. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish and buying super microcomputer or bearish and selling. Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, to make better financial decisions. This is how smart money always stays one step ahead before the rest of the market catches on. No wonder the rich get richer. And so to level the playing field, let's dive into our analysis to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, the most unusual trade happened on May 13 at 12:02 at the 59-second mark for these June 20 options at the 31 strike calls and the 36 strike calls. Now, if you're in our membership, these 31 strike calls would look very familiar because just last week on May 7th, we detected these same options being traded. And so we emailed our members about this unusual trade. This was the email we sent out to members, alerting them of unusual option activity detected on May 7. And so you can see here, we analyzed SMCI, super microcomputer, and went long bullish when the stock was trading at $31.22 per share. That's because a wealthy investor bought these June 20 options at the 31 strike calls, the same options being traded now. They purchased a total of 46,886 contracts at a price of $350 each, or $350 per contract, since option prices are quoted per share and each contract represents 100 shares of stock. That's why we move the decimal 2 places to the right or simply multiply by 100. And take a look at how much those options are worth now. $835 each. So clearly a profitable trade. Now, based on our analysis, this wealthy investor closed these options to lock in profits and then rolled the gains into a new trade to a higher strike price into these 36 strike calls. We followed that trade too by tracking the smart money. So these June 20 options at the 36 strike calls are the new open trades. And so let's calculate the total cost of this new trade. The option price was $4.85. And since options are priced per share, we multiply by 100 to convert it to dollars per contract. That gives us $485 per contract. And we multiply that by the quantity of 46,886 contracts. And we get a total of $22 million for this new trade. But keep in mind, just because a trade is large does not necessarily mean it has a high probability of success. In fact, this one carries more risk than the smaller, more selective trades we share on our website. And so, if you want to get access to smarter, lower risk trades with a higher chance of profit, head over to our website. We'll put a link to our website up here where you can get deep insights into exactly when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, with that said, even though this trade carries higher risk, we still took it. Why? Because we managed the risk by rolling our previous position from the 31 strike calls to the 36 strike calls. The same strategy this wealthy investor used. And take a look. There are now over 57,000 open contracts at the open interest, showing strong activity and continued interest in this trade. And based on our deep research across multiple variables and other data sets, this wealthy investor bought these 36 strike calls for $4.85 each, the same price as we calculated and saw earlier on the options time and sales tape. And so when we analyze this trade, You can see here on the risk profile graph where the profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, as the share price goes down, this trade becomes more negative loss. And as the share price goes up, this trade becomes more positive, more profitable, because this wealthy investor is still going long bullish on super microcomputer stock. And notice how the maximum loss or risk on this new trade is simply the cost minus $485 per contract. But remember, this new trade was rolled from a previously profitable position. So to calculate the actual risk, we need to factor in the profits from the 31 strike calls we closed. And so if we look back at those options, they were originally bought for $350 each and now closed for $835 each. So to calculate the profit, we simply take the difference, $835 minus $350, which gives us a profit of $485 per contract. Coincidentally, that's the exact same cost as the new trade at the 36 strike calls. So essentially, we used all our gains to fully pay for this new trade, meaning no additional capital was added, and the net cost is zero. So if the stock goes down, we do not lose anything. You can see we have no negative loss at all. This is a risk-free trade now because we already locked in gains equal to the cost of the new trade. And so by managing our trade this way, we eliminated our downside risk while still leaving room to gain more profits if the stock continues to move up higher. But keep in mind, this was only possible because we followed this wealthy investor early, just last week on May 7th, and caught the recent 20% move in the stock. So if you want to get access to these smart money alerts we send by email, just sign up on our website. We'll put a link here. Let us know in the comments. Do you think super microcomputer will continue to go up higher, or do you think it will crash back down? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.